A new bill was proposed last week that got a ton of attention. It proposes kicking out large institutional investors out of the US housing market. It would also force them to sell their houses over a 10-year period. However, though, if passed, would this help improve housing affordability in the United States? In today's video, I'll provide all the details and also share my own thoughts regarding will this actually help everyday Americans right now. This proposal, by the way, was just posted on December 5th. This is called the End Hedge Fund Control of American Homes Act of 2023, which was proposed by U.S. Senator of Oregon, Jeff Merkley, and U.S. Representative Adam Smith, a Democrat from Washington. This legislation responds directly and forcefully to a persistent and growing problem. What happens when Wall Street buys most of the houses on your block? That's based on an article from the New York Times, by the way. The purchasing of single-family houses by hedge funds, especially in the current housing market, has made it more difficult for middle-class Americans to become homeowners and is contributing to America's twin crisis of housing affordability and wealth inequality. They also say here that housing in our neighborhoods should be houses for people, not profit centers for Wall Street. Yet, in every corner of the country, giant financial corporations are buying up housing and driving up both rents and home prices. That's according to Senator Merkley. It's time for Congress to put in place common sense guardrails that ensure all families have a fair chance to buy or rent a decent house in their community and at a price they can afford. In 1971, my father was able to buy a house I grew up in for $15,000 on a salary he earned as a baggage handler at the SeaTac Airport. I believe that's an airport in Seattle. Correct me if I'm wrong. That same house would cost nearly $500,000 today, yet wages for workers like my father have not kept up. That's absolutely true, right? We see, especially over the past several years here, giant increase in home prices up by about 45% compared to 4 years ago, whereas wage gains are not even close, especially when you account for the fact we have high inflation now. So of course, because of that, a lot of American families are not able to realize their dreams about buying a house in the United States, whereas back in the 1970s, it was actually more commonplace here. He also goes on to say the following here. This crisis has been exacerbated in recent years by an increasing number of large investors purchasing a significant percentage of single-family houses, squeezing out prospective homebuyers. I actually do not agree with him at all, to be honest with you guys. I have a lot of thoughts to share regarding this because I think we should put the ownership on the Fed rather than large institutional investors. The Fed is to blame here, in my opinion, because they dropped interest rates back in March of 2020, and therefore we had record low rates for mortgages. And because of that, that caused a feeding frenzy amongst home buyers, which of course drove up home prices as well. I have a lot more to share regarding that, but let me just share some stats as well. So here's a report from the National Association of Realtors just posted on November 21st. They say here in this article here, or this report from the National Association of Realtors, that all cash sales accounted for 29% of transactions in October. So about 3 of every 10 houses that were purchased in October, based on this survey, came from an all-cash buyer. Institutional investors or second home buyers who make up many cash sales purchased 15% of houses this October. Now, here's what Rick Palacios Jr., he's the director of research at John Burns Research and Consulting. He actually tweeted, or what do you call it, X'd? Whatever it is called now. He actually, let's just call it tweeted. He posted on August 9th this year that investors accounted for about 24% of all U.S. home purchase activity in Q2 2023. As is always the case, small investors were the overwhelming majority of those purchases. These mom and pop investors bought 64 times the number of houses that institutional investors did in Q2 2023. Here's a great snapshot looking at that share going back to Q2 of 2004. So tier one investors are these mom and pop investors purchasing in the range of 1 to 9 properties. So in Q2 this year, that made up 125,006 home sales. That was 19.6% of all investor purchases in the second quarter this year. That was 19.6% of the total amount of houses that were purchased in the second quarter this year. Compare this to investors purchasing at least 1,000 properties. There was only 1,959 sales. That was only 0.3% of total purchases in the second quarter this year. For investors who purchased in the range of 100 to 999 properties, that only was at 4,700 to be exact. That percent was at 0.7%. For properties for 10 to 99, that was nearly 17,000 sales, only 2.7%. So the vast majority of home sales purchased by investors during the second quarter this year came from everyday mom and pop investors and not institutional investors. But wait, there's more. Here is a look at the amount of houses owned by investors according to Ryan Lundquist. He's a real estate appraisal based in Sacramento, where I live and work as a real estate agent. He actually came up with this really good map showing the number of investors or large investors who own houses in California. Based on his research here, posted on December 4th, he said here that Invitation Homes owns over 9,000 units in California. And they have a map here showing this, which by the way, I'll have Ryan on my channel to share this map with you guys because I found it to be absolutely fascinating because he actually did a deep dive into where are these properties owned nation or statewide in California here. So based on his research here, Invitation Homes owns about 80,000 units across the United States here. He also says here that Invitation Homes should not be confused with Blackstone though, because they used to be affiliated, but that's no longer the case. He says here the bulk of these units, again, 80,000 units across the country and about 9,000 in California. The bulk of these units that were purchased 5 to 11 years ago. He says here, I'm not aware of any location in the state where Invitation Houses is currently acquiring a large number of units. In Sacramento, Invitation Houses went on a rampage in 2012 and 2013 and purchased more steadily in subsequent years. The last unit they bought was in mid-2022, as far as you can tell. I can tell you the landscape back in 2012 and 2013, which is absolutely insane regarding first-time home buyers and investor purchases. I should say investors versus first-time home buyers. And also just everyday Americans want to buy a house as well. So I got my real estate license back in early 2013. Just want to provide a story regarding this because I'll circle back later in the video here. Anyways, I got my license back in February 2013. I started working with a real estate team back in late 2012. During that time, our housing market in Sacramento was just absolutely insane. During a span of about 6 months, we wrote about 900 all cash offers in which we didn't even look at the house prior to writing an offer for investors. And that, of course, caused a huge increase in the number of investors who owned houses in 2012 and 2013. In mid-2013, because prices increased so much and rents were not increasing as fast, a lot of these big investors stopped buying houses altogether in mid-2013. So in my opinion, the damage was done in 2013 and the first half of 2023 or 2013 because there was a large number of real estate investors, especially hedge funds and private equity funds that were buying houses in masses because the returns were great, buying houses for about $100,000 to $150,000 in Sacramento and renting them out for about $1,000 to $1,500 per month. That was a great investment back then. And in my opinion, this legislation probably should be enacted about 10 years ago and not now. In any case, getting back to Ryan's report here, it says here, they haven't sold a massive amount through the years other than some non-performing assets. This is only one investor invitation houses. So in any case, getting back to this proposed bill here, and also I'll provide a summary and also some additional thoughts I have regarding this at the end of this video here. According to Representative Adam Smith, he says Congress must take action to crack down on corporate greed and get hedge funds out of the single-family housing market. The bill I'm introducing today, which was last week, with my colleagues, would ban these problematic hedge funds from the single-family housing market and claw back some of those houses they already own so that more American families will have a fair shot at becoming homeowners. It says here in 2011, no single entity owned over 1,000 single-family rental units. As of June 2022, according to the Urban Institute, they estimate that large hedge funds and other institutional investors own roughly 574,000 single-family houses. The End Hedge Fund Control of American Homes Act seeks to put an end to this harmful practice of hedge funds buying up single-family houses by banning hedge funds from owning these types of houses and requiring them to sell at least 10% of the total number of single-family houses they currently own to families per year over a 10-year period. After this 10-year phase-out period, all hedge funds on a national level here will be completely banned from owning any single-family houses. This bill, by the way, is also co-sponsored by U.S. Senator Tina Smith, a Democrat based in Minnesota. In addition, it's also co-sponsored by the U.S. Representatives Nikema Williams, based in Georgia, as well as Linda Sanchez, also a Democrat based in California. So the big question, of course, is will this proposed legislation will actually improve housing affordability for everyday Americans nationwide here? So here's a summary for you guys and some thoughts I have regarding this, because I know this is going to be very triggering for a lot of you. This is according to my own analysis here. So the U.S. median sold price, this is from October 2019 through October this year, has increased a whopping 45%. So home prices overall, according to the National Association of Realtors, have increased a whopping 45% over the past 4 years. The key question, though, is why have home prices increased so much over the past several years? In my personal opinion, we have underbuilding for over the past 15 plus years. So let me share a snapshot of that. Here's the number of housing starts for single-family houses according to the U.S. Census Bureau on our good Uncle Fred's website here. These numbers, by the way, are seasonally adjusted and also annualized as well. So the most recent stats we have is actually for October, the current pace of housing starts of single-family houses. So this is the beginning phase of the construction of a brand new house nationwide. That current sales pace is at 970,000. What I want to focus on is this right here, 1990 through now. What do you guys see? This is what I see. In 1990s, let's just call it 1994 through 2000, the average approximately was around 1.2 million housing starts on a national level, right? Of course, we saw a huge surge right before the onset of the Great Recession, and we peaked at around 1.8 million. Now, again, we're approximately half that. And then, of course, after the fallout of 2008, we saw a huge decrease of home builders who opted not to start construction because our economy and our housing market was was in big trouble, right? So ever since then, we have been seeing this slow increase in the number of housing starts, but from this time frame of 2010 through the onset of COVID back in 2020, we didn't get above really 1.1 million. Whereas before the Great Recession, again, the average was around 1.2 million. To be exact, in the range of 1 to approximately 1.3 million. So the reason why I mention this is that because of we had the Great Recession here, huge fallout of construction, and because we're only seeing this a small increase, and again, this level right here is way below the pre-Great Recession levels. This is one reason why we have historically low levels of existing houses for sale. So kind of just think of it this way, because there might be some confusion regarding this. If a house gets built today, this will be tomorrow's existing home sales and tomorrow's existing house inventory. Not exactly tomorrow, but you get what I'm getting at. Because when a home builder builds a house, of course, someone's going to buy the house, and 1, 2, 5, 10 years from there, they're going to sell their house. It's going to become a part of the existing house inventory. But because we have underbuilding for about 15 plus years, this is limiting the amount of existing houses for sale right now. And here's actually a really good snapshot looking at the total number of existing houses for sale according to the National Association of Realtors. So as you guys can see here, right before the Great Recession, we had around 2.4 million existing houses actually for sale. Right now, around 1.1 million. On top of that, prior to COVID, which is right about right here, we had around 1.5 million homes for sale, well below the average from 2012 through 2016, when there was around 1.8 to about 2.4 million houses for sale. I mentioned that because obviously when we had all-time record lows for rates or mortgage rates, that of course caused this feeding frenzy amongst home buyers, and that really decreased the amount of houses for sale. So even before we had all-time record lows, and also even before we had the onset of COVID, back in early 2020, we already were starting at very low levels in the number of houses for sale, historically speaking. And of course, when there's a low level of the amount of houses for sale, of course, that puts upward pressure on prices as well. On top of this, what happened in March? Of course, in March, Congress passed the CARES Act. And the CARES Act put in place a lot of different parameters here. So for number one, it put a federal moratorium on foreclosures for about 1.5 years. So the federal moratorium was in place for about 1.5 years through July of 2021. And it started back in March of 2020 when the CARES Act was passed. Of course, no big surprises. That, of course, limited foreclosure inventory for about 1.5 years. And of course, we're still at very low levels as well. Also, number two, the CARES Act also allowed homeowners who were experiencing a financial hardship, whether related indirectly or directly to COVID-19, they could get up to a 18-month mortgage loan forbearance. In other words, for about 18 months, the maximum period, homeowners who signed up for a forbearance didn't even have to make their mortgage payment for that time of period. Also, as I mentioned right here, although not everyone took advantage of the full 18 months, there were approximately 9 million homeowners who did enter into a forbearance. This limited the amount of people listing their house for sale during this time frame, and many chose to refi when rates dropped to all-time record lows in the range of 2.7 to 3%. On top of that, the CARES Act also had several rounds of stimulus checks as well. So this is all limiting inventory levels, and of course, which drove up home prices as well. What also happened in March of 2020, the Federal Reserve held 2 emergency unscheduled meetings to drop the federal funds rate to 0%. So in a span of 2 weeks, they dropped the federal funds rate by 150 basis points or 1.5 percentage points. The Fed also bought trillions of dollars worth of mortgage-backed securities. What was the effect of this? The combination caused rates to drop to record lows, and also that created a feeding frenzy amongst home buyers, which of course drove up home prices greatly in 2020 through the first half of 2022. The drop in rates also impacted supply as well. So the record low rates we had in 2020 and 2021 not only stimulated home buying demand, but also caused a supply issue as well. So when the Fed decreased the federal funds rate to 0%, they're trying to stimulate the economy in order to avoid a housing market crash and a crash in our economy. That caused demand to rise big time. People got their stimulus checks. They purchased goods and services. They also bought houses as well. That really stimulated our economy. But the side effect, I should say the lagging effect of this also created a lock-in effect in which people have rates in the range of 2.6 to 4% and they're opting, or they have not opted, to sell their houses because they don't want to give up their historically low rate. So the effect of the Fed decreasing rates to 0% stimulated demand, but also decreased supply as well, which made housing affordability even a worse scenario than we did back in 2020. So big picture here, in my opinion here, institutional investors have some to blame for the run-up in prices over the past several years. However, the Fed is more to blame in my personal opinion. Hindsight, of course, is 2020, but in my opinion, the Fed should have started raising rates much sooner than March of 2020, because by that time, it was too late. We had reached all-time record highs for home prices back in the summer months of 2022. The damage from large institutional buyers purchasing single-family houses was also done long ago, back in 2012 and 2013, when there was a feeding frenzy amongst large buyers and large private equity firms buying single-family houses. Additionally, the End Hedge Fund Control of American Homes Act 2023 is just a proposed bill. It's not approved legislation. Additionally, as of late last week, the bill has yet to gain support from the White House or leadership from the House or the Senate. With that said, please leave me a comment below with your thoughts regarding this controversial bill that was announced late last week. I got a lot of comments on my YouTube channel regarding this, and so hope it provides some context regarding the run-up in prices and really what really caused the run-up in prices as well. But if you guys have any additional perspectives, whether you agree or disagree with me, totally okay. Please leave me a comment below, and let's just kind of have an open discussion regarding this new bill that was proposed last week. And with that said, I appreciate you guys watching today's video. If you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, I appreciate you. Hope you have an awesome day. I look forward to seeing you in the next video.